please welcome your MC and host for the day, Lynette and Thuli.
Good afternoon, ladies and gentlemen, and welcome to the very first 1nvest Think Forum. On this very wet afternoon in Johannesburg, in the midst of a load shedding crisis, what a pleasure it is for me to host a conversation this afternoon with thought leaders and experts on the index tracking funds, some of the future trends that you and I need to look out for, as well as the current as well as ongoing status quo of some of the issues that have begun to count, technology amongst them, separating fads from fundamentals, and of course taking a discerning look into what does the economy and its forecasts really mean for you and I on the other side of the asset management desk. My name is Lynette Nduli, and this afternoon I will be your guide through an exciting program and interactions with our guests. And of course, as I'm also your guide, I'm really looking forward to what all of you have to say about this event, your inputs, your questions, and perhaps some of the best practice that you are in the middle of implementing in the space that you're in. To allow that over the next 2.5 hours of our time together, please, I urge you to use the chat functionality. And I, of course, will be checking it out and of making sure that your questions, your pertinent and relevant questions, are answered by our panels of guests, as well as those guests who will be joining us virtually from around the globe. Throughout the course of this afternoon as well, we will be checking in on some of the key themes, as well as your focus areas as our audience in the asset management sector. So please do follow our polls and do respond, because again, it helps me to keep a pulse on what's going on the other side of our screens this afternoon. You can see the Mentimeter application. It is also available on your phone. You will also see the pop-up screen. The QR code will come up on your screen shortly. And of course, grab your phone, scan the code, and that will allow you to then download the authenticator, which will make it really easy for you to keep in touch and, of course, communicate your thoughts around the themes with us right here in studio this afternoon. If you do have a problem connecting into the chat, please click on the link and add in the code that you'll probably see on the screen now, 648-08-553. Ladies and gentlemen, throughout the course of this afternoon, we will hear a lot of information and thought leadership. However, please be reminded, as per the disclaimer that is now scrolling across my screen, that this information is brought to you by 1nvest fund managers purely for information sharing purposes only, and of course, terms and conditions do apply. We will also be making sure that this content is made available to you at the end of the event. And at this point, to tell us a little bit more about some of the ideas and his expectations of what you and I should look forward to is Veermeyer Ferreira, who is 1nvest Executive Director. Welcome, Veermeyer, and I'm looking forward to the forum this afternoon and a lot of the thoughts that are going to be presented by yourself, your colleagues, and of course, your industry colleagues who'll be joining us. Tell us a little bit more about 1nvest fund managers and what the Think Forum means for your business.
Thanks for Lynette.
Yeah.
And thank you for hosting us here today. I think it's been 2 years in the making. We've been through, I guess, like everybody, through quite a difficult period in the last 2 years, settling into normal that was supposed to be short, and then it was longer than everybody anticipated. So this feels like a bit of a return to normal. We're not at home anymore, at least in studio, so get to put on my pants, not only my jacket for this session. So getting closer to connecting with advisors again, connecting with people out there. And the Think Forum was to do exactly that. But what we didn't want to do is just give a single perspective. So I think this afternoon, hopefully we can bring together various different perspectives, which I think is important to form a holistic view of, I think, difficult problems we are faced with today in the financial industry. I think change is a theme that is going to be around for a lot longer. And as things change, if you don't adapt, you're going to be left behind. So hopefully by bringing together various perspectives,
Yes.
we give people some insight into how to adapt for the future.
Oh, absolutely, Mayor. I love just some of the thoughts you've shared with us this afternoon. And I certainly hope that we bring fresh ideas. We innovate differently in studio this afternoon. And of course, those who may be struggling with the issues of agility, perhaps in their businesses, and catching on some of the trends we're going to showcase as part of the discussion will enjoy what we have in store for them today. I know that from your perspective as well, this Think Forum, this is the very first time you've done it.
Yeah.
Do we look forward to more Think Forums in the future? And how, of course, will you continue to engage with the audience that has joined us this afternoon as you move forward?
Yeah, I think when we launched 1nvest, one of the key themes for us was to educate and try and share our views without trying to just push our product down advisors or clients' throats. So I think the idea of the Think Forum is to really share what we know quite openly without discriminating against who we're sharing with. And I guess that we're going to continue going forward. So I think Think Forum is one of the first steps in that journey in terms of just being very open around sharing knowledge. So hopefully we'll see you again. Hopefully we'll see the advisors again in our journey forward.
Well, to those audience members who are joining us at home and are probably wondering, well, what are index tracking funds about? And what does this have to do with me? Veermeyer, what do you have to say? Or perhaps do you have something to show us? A little bit about the behind the scenes of some of the fantastic work you do.
Yeah, in a session later on, Lynette, I'm going to be sharing a bit about what the index tracking industry is all about, where we came from, where we are today, and what the future looks like. But in essence, it is a way for clients, both advisors and end client, to access market returns. And that's the simplest way to put it, to access market returns in the most simplest way. And with simplest, I don't mean it is trivial. I mean it is to the essence of what you want. And I guess that's what we hopefully going to show this afternoon. Even though the choice is enormous, the industry has evolved quite aggressively, but the delivery mechanism remains very easy. And that's what we want to share with the clients.
All right. Well, I certainly hope that as we delve into the issues of evolution, the issues of equity within this particular space, and of course the economic impact of what our index tracking funds are actually doing in our market, you of course will also continue to give us your input, some of your advice, and we'll be able to take that information and convert it into very, very useful knowledge as we carry on with what is left of a very challenging, but nonetheless, an exciting year end, particularly, as you've said, we're moving forward now into a future sort of known, kind of unknown, but nonetheless known that we have to get there. So over to you, Veermeyer, in terms of, is there anything else you'd like to offer our guests at this point?
Yeah, I guess, Lynette, before we actually kick off, let me just share a bit about 1nvest. And 1nvest, we actually had our second birthday about a month ago. So we launched in 2019, October. It was Standard Bank, Liberty, and Stanley coming together to join forces, and it was basically a marriage between the entities. But without giving you more information, let us rather go to a short video that's going to show the advisors and the asset aggregators that join us today what 1nvest is all about.
Take control of your investment portfolio with 1nvest. Our specialist index asset manager backed by the largest financial services group in Africa. Boasting a comprehensive index product range that includes 13 exchange-traded funds and 15 unit trusts across a broad spectrum of asset classes. We're not conventional fund managers, and transparency is everything. No obscure terms and conditions or hidden fees. This enables us to cater to our clients' unique investment needs and is all done in a simple, transparent, and cost-effective manner. Enjoy the simpler way to invest with 1nvest. For more information, visit 1nvest.co.za or contact us on info@1nvest.co.za.
Well, Thank you so much to Veermeer for that introduction to 1nvest Fund Managers. As we now move on with our program, I think it's really important for us to set the scene. And what better way to do that by looking at some of our current realities, as well as the outlook for the global economy and asset classes over the next 5 to 10 years. So joining us now all the way from London is Standard Bank economist and head of their G10 strategy, Mr. Stephen Barrow. Good afternoon, Stephen.
Afternoon. Thank you for having me.
Thank you.
Okay, so what I'm going to talk to you about is the economic outlook over the next 5 to 10 years. Likely to be quite a challenging one. What we can see, or what we may be anticipating at the moment, is that the environment is perhaps somewhat difficult. We have a lot of what I would call current concerns going on globally. We've obviously seen the deepest recession that we've seen in decades. There's quite a lot of angst about possible supply chain difficulties that are with us at the moment, and are certainly boosting inflation in many of the major countries and many other countries besides. There's also arguably a stagflation risk. That's the combination of weak growth and high inflation, something we haven't seen since the 1970s. There's also concerns that the central banks, the major central banks, led by the Federal Reserve, will have to act quite aggressively to stem some of these inflation threats by raising interest rates. And that could be something that causes problems in terms of the emerging market world, for instance. And all of this at a time when I think when you look across asset prices, whether it be bonds or stocks, in many countries, certainly in the advanced countries, there's concerns that those asset valuations are already quite high. So I think in a sense, there's maybe a sort of wall of worry that is out there at the moment. But I think when we look over the next 5 to 10 years, I think there's some reasons for actually more optimism than perhaps we're seeing at the moment. I think for one thing, I think that a problem in terms of global growth is that we've had very weak productivity growth amongst the labour force, and I think that could improve as a result of COVID. I think that whilst inflation is higher, it's not necessarily the case that all inflation is bad. In fact, it may even be good. And I think that also when we look at how central banks will respond and the tightening policy that may have to happen from the likes of the Federal Reserve and other central banks, I'm actually reasonably hopeful that that won't cause significant problems as far as emerging markets are concerned. So I think overall the message for me is actually more an optimistic one than a pessimistic one. When we look out 5 to 10 years, there has to be a question mark perhaps about maybe the short term, but longer term, I think there's probably more reasons for optimism than pessimism. We move on to look at the sort of growth outlook. First of all, we can see on this left-hand chart that growth has generally been coming down. The orange lines on there represent inflation per decade going back to the 1960s, and you can see that globally that growth rate has been generally tending to come down. And I think that is something that is obviously a concern for the future. Will growth continue to slow down? And I think that the second chart on the right-hand side is arguably something that perhaps provides a little bit more optimism on that front. And that's to do with productivity. I mean, I think if we ask ourselves why growth has been trending lower for many decades now, what we'd say is that there's been things going on like quite weak investment, quite weak productivity amongst certainly the big countries, like in the US and in Europe, for instance. And a lot of that is because they've outsourced their production to other countries, particularly in Asia, particularly China, and they haven't really invested sufficiently at home. What I think the pandemic will do is it will force them to invest more locally. Indeed, there was some a pandemic about 100 years or so ago, the Spanish flu, which you may have read about. And that has certainly been something that did subsequently actually see an improvement in productivity. There was lots of things going on at the same time. World wars, for instance, and I've used the chart here of the UK productivity data because we've got a long history of that. I think the thing is point out though is that it's a similar picture as far as other countries are concerned. So in recent decades, productivity performance of labour and capital, which is what we call total factor productivity, that performance has generally been quite poor. But I do think that as we move on from the coronavirus crisis and the supply chain difficulties that firms are experiencing, not just in terms of goods and services, but also in terms of labour, will actually mean that the firms will invest more and that will improve productivity. So I'm actually reasonably hopeful that this significant downtrend in productivity that we've seen is actually something that will start to turn around. Now, if we move on to the next slide, we can see here that there are significant inflationary problems around at the moment. That is due to the fact that a lot of firms are experiencing supply chain difficulties. And the chart on the left-hand side, for instance, shows how, if you look at firms in the UK and the US, as they report their price expectations for the future, you can see that those levels are really very elevated indeed. And that's certainly something that is of concern in terms of the more immediate inflation outlook. And indeed, I've used the UK and the US here because I think it's quite indicative of what's happening. We're seeing this across many countries. So inflationary pressure, as we know, is picking up. What is interesting is that it's picking up quite substantially more in the advanced countries than in the developing countries. The chart on the right-hand side shows how the IMF's forecasts, for instance, have changed between their review they did back in April and the one that they just completed in October. And you can see their inflation expectations for the advanced countries have gone up quite sharply for this year, and more so than emerging market countries, and more so as well than we see for next year as well. So I think a lot of the inflation problems are more something that applies to what's happening in the advanced countries than in the developing countries. And if we move on to the next slide, what we'll see there is, I think, the reason for it, and very simply put, what has happened with the COVID crisis is that the big countries, and the US in particular, have really overstimulated. Of course, these policymakers didn't know what was happening or what was likely to happen during the course of coronavirus. They didn't know how big the economies would be hit. They didn't know how much they had to increase spending or reduce taxation to try to lift growth. This chart shows, again, advanced economies and emerging market countries, and shows how the IMF has adjusted its forecast as a result of what has become known during the coronavirus crisis. So starting off in 2019, the IMF thought that growth would weaken and then recover, and it didn't. But what we've started to see is, or what we have seen already, and what we continue to see in the future, is in terms of the fiscal spending, it's really the advanced countries that have pulled out all the stops. Some of the fiscal spending in advanced countries has been truly huge. The US has spent a quarter of its GDP trying to stimulate the economy, and we've not seen the same thing as far as emerging market countries are concerned. And that really is due to things like affordability. So although the revenue impacts of COVID have been similar, what's happened in terms of expenditure is we've seen far more expenditure from advanced countries than we have emerging market countries. And I think that's a large part of the reason why the inflation problem is more one in advanced countries. There's a lot of focus on that inflation is being created and will be created in the future by supply constraints, and that indeed is part of the issue. But I think an understated part of the issue is that it's been demand that has really been pushed up quite aggressively in the advanced countries as they've tried to tackle the coronavirus crisis. We can see in this next chart as well, if we look at the monetary side of the equation, again, some of these advanced countries here, we're looking at the US Federal Reserve and the European Central Bank on the left-hand side. That shows the excess liquidity in their banking systems at the moment. That's sort of the amount of liquidity that the central banks are supplying to these banking systems. There's above and beyond essentially what they need. Those excesses increased after the global financial crisis, but during coronavirus, they've really increased very dramatically. And the corollary of that has been we've seen these very big increases in money supply growth as well amongst, this is all the OECD countries on the right-hand side, all the major countries, but particularly in the advanced countries. So if we go on to the next slide, I think the interesting thing for me is that although we've seen, a big increase in money supply growth in terms of the major economies, up until fairly recently, we hadn't seen any significant inflation. And that seems strange in some senses because when we have big increases in money supply, very often people think that means big increases in inflation going forward, sort of too much money chasing too few goods. That's the way that sort of monetarists have described inflation. Interestingly, though, I think what's happened for many years now, and this is being challenged at the moment, but what has happened in previous years is that when money supply growth has been strong and global demand has been strong, there's always been the goods and services to supply that extra demand. And that's because, of globalization. The chart on the left-hand side shows globalization in terms of the whole world. South Africa as well included in that, which obviously globalization increased quite markedly after the end of apartheid. And China as well, which has been a very big part of this globalization push. This basically meant that as companies in the West have required increased output, if they can't do that domestically, they've been able to get extra output by outsourcing to other countries. So China in particular, rest of Asia, many other countries. So there's been a very strong supply of goods and services. And so when demand has been strong in the world, we've seen those goods and services supplied, and we haven't seen inflation rise as a result. On the other side of the coin, the inflation instead has been in asset prices, not in goods and services prices. And that's largely because the supply of those assets, whether they be equities or fixed income securities, that has been relatively static. That chart on the right-hand side shows global sort of increase in the supply of debt and of equities. And that's actually been fairly flat up until the last year or so. So whilst we've seen the supply of goods and services really quite strong, we've not seen significant increase in the supply of assets, and particularly bonds. Many big central banks have been buying bonds themselves as part of their quantitative easing strategies. So I think what all this has done, if we look on the next slide, is it's created inflation. The inflation that we've seen really for quite some period of time, if you look back over the last decade, for instance, has really been in asset prices. It's not been in goods and services prices. So this shows some prices of some assets. We could have, picked out particular examples. There's many more besides US stock market. How many negative yielding global bonds we have now. We have significant increases in the amount, 15 trillion of bonds globally now that are yielding below zero. So those levels are very high. So that shows the strength we've had in bonds. We've had strength in commodities. If you look at gold prices, for instance, could have used other ones. And contrast that with the right-hand side, which shows, or the bottom right chart, which shows goods and services inflation, the CPI inflation. That's actually tended to be fairly low. So the history, in a sense, is that, if you look back over the last 10 years or more, is that we've had the inflation in asset prices and not in goods and services prices. And that may seem like a good thing, but I actually would argue that we probably need to see some increase in inflation. And we are starting to see that now, which is in a sense a good thing. I know there's lots of concerns about inflation at the moment, but it is a good thing because I think that it helps the big central banks like the Federal Reserve and others get away from this situation where they are always having to push interest rates down to, near zero levels. If we look at the next chart, I think also that there's some scope to believe that inflation will be higher over the longer term as well, and that's because of demographics and also globalization. So I start with the chart on the right-hand side, which shows that same globalization chart I showed before. What you notice as we come to the sort of more latter part of the period is that globalization has started to flatten off. And I think that will continue, and you do hear talk about deglobalization. So I do think that will mean that the global supply of goods and services is not as amenable as it has been in the past, and that could mean higher inflation going forward. Demographics as well, I think, are quite an important issue. This chart on the left-hand side shows essentially how many retired people there are, or plus 65, per 100 of the working age population. And as that rises, it shows you have more elderly relative to those that are in work at the moment. And the shaded region shows the forecast for the next sort of 50 years or so from the UN. And what we notice here is quite a significant increase, particularly in advanced countries, but also on a global level, a real inflection point, I think, as what we'll see is a rapidly aging population. And as a population ages across the world, elderly people tend to spend money, they don't tend to work, they don't tend to produce anything, and they don't tend to save either. And that, I think, has significant consequences in terms of higher inflation and in terms of also the balances between savings and investment and what it implies for interest rates. If we move on to the next chart, I think we see here, again, if I start on the right-hand side, that one thing that's been lacking globally has been investment, and savings has been relatively high. And when you have quite high savings relative to investment, that tends to put downward pressure on interest rates. It means that growth is perhaps relatively muted. It means there's lots of available cash to be invested into assets like bonds or like stock. And we can see on the left-hand side, again, and I've used the UK, so we've got a long history there of how long it's been that global these interest rates in this country have been coming down, but interest rates globally as well have been coming down also. So I do think that probably looking ahead, demographics will mean that the increase in, and also other factors will mean that this gap between savings and investment will tend to close up. Investment will tend to rise relative to savings, and that will start to turn the interest rate cycle back up again. Obviously, policymakers do look as if they will do that from raising interest rates, but I think that bond yields as well will tend to move a little bit higher. If we just move on to what will be the last chart, the one thing that is of concern, obviously, when we talk about raising interest rates, and particularly when we talk about the Federal Reserve raising interest rates, is that that's something that could negatively spill over and hurt emerging market countries through their currencies, maybe some countries having to raise their own interest rates to defend their currencies. So there is a concern on that front. I feel a little bit more hopeful about that, just on the basis that I think the Federal Reserve in particular, but also other central banks, have worked quite hard to supply lots of currency, lots of dollars, for instance, when events have happened that have created some tensions in the market. So this chart on the left-hand side shows central bank swaps, and that's basically just the Federal Reserve lending out dollars to other central banks when periods of tension happen. So as we saw in 2007 with the global financial crisis, 2010-12 during the Eurozone debt crisis, and more recently during COVID. And what that's done, if we look at the right-hand side, is I think it's eased some of the pressures we often see when tensions arise. And this is shown in what we call basis swaps. That's the cost of securing dollars in the market. This is a euro dollar we've used as an example here. And you can see in the earlier two spikes during which we saw the central banks swaps increase, that there was quite a lot of tension there, that those basis swaps moved down aggressively. That meant it was quite difficult and quite expensive to secure dollars. During the COVID crisis, that wasn't the case. We didn't see the same movement in basis swaps. So I am more hopeful on that front that if we do, as we do see the Federal Reserve raise interest rates, then I do think that the impact of that on emerging markets will actually not be as concerning as maybe many people feel. So just the very last slide now is just really some of the conclusions. I'm not going to talk over this because I think my time's just about up, but it relates to some of the things that I've been talking about. And as we go through the rest of the session, I'll be happy to obviously take any questions on this that may come from any of our viewers. Thank you.
Thank you so much, Stephen, for that presentation this afternoon and really just setting the scene for some of the key indicators and indexes in developed as well as emerging markets that we need to look out for. The one question, Stephen, this afternoon, I think I'd really like to ask you, past those of sentiment, perhaps even inflation, and even some of the best equity markets for us to look at, is which particular emerging market for you stands out in terms of its recovery post-COVID, that has strong policies in place, and of course a strong outlook over the next 2 to 3 years. So Stephen, before you answer that question, to the members of our audience, please just note that if you've got any questions for Stephen, you can post them to us in the chat. Stephen, back through to you.
Yes, thank you. I mean, an important part of the talk that or the view that I have is to do with the demographic argument. Particularly if we're thinking about the next 5 to 10 years and even beyond that, because I do think that the world and particularly advanced countries now are starting to realise, well, maybe there isn't this sort of almost inexhaustible supply of labour and goods that can be sourced from China, perhaps, where the demographics are starting to become more challenging there to some extent. And maybe, from an equity perspective, maybe we should look at those markets that will be, in a sense, that maybe the next generation of suppliers of labour. I think it's too soon for Africa, probably in some senses. I think, maybe if we were thinking about the next 20 to 30 years, then perhaps the story there would be maybe slightly more attractive. On a shorter-term basis, you'd probably look for some of those Asian countries that are already performing reasonably well. India would perhaps be a good example, although there is perhaps an argument that equity valuations in India are already quite high. So probably still some of the Asian markets for the moment, but I think Africa definitely will come into the frame in a longer term context because the demographics there are very different in many respects to how they are certainly in advanced countries and certainly in most of the other emerging market regions as well.
So thank you very much, Stephen. I guess the name of the game now is patience and of course just building resilience into some of our outlook and the actions and activities that follow them. Stephen, thank you again to you. Now, ladies and gentlemen, it's time for our very first poll. You will recall from the beginning of our presentation, we did say you are welcome to ask your questions and share your thoughts through the chat with us. But in the interim, please answer these 2 quick questions for us, and I'll of course let you know what you and your colleagues who are joining us this afternoon on the 1nvest Think Forum think too. Now, as we move past the poll on your screen, let's get cracking with the rest of our program and begin to tackle, of course, the issues and the emergence of thematic investments. And at this point in time, I'd like to welcome the next panel of speakers. Joining me here this afternoon in studio is the head of Momentum Investment Consulting, Flobela Yates. Good afternoon, Flobela, and welcome to the studio this afternoon. And dialing in from London this afternoon to tell us a little bit more, share with Flobela some of their insights and best practice, are Yaz Romahi, who is the CIO for Quantitative Solutions at JP Morgan Asset Management, as well as Ari Rajendra, who is the Senior Director for Strategy Indices at S&P Dow Jones Indices. At this point in time, ladies and gentlemen, I am going to hand over to our moderator, and she, of course, is going to have the task of guiding this conversation, asking the hard questions, and making sure that you and I can get the very best of the two brilliant minds that are joining us from halfway across the world this afternoon. Over to you, Flobela.
Thank you, Lynette, and thank you to 1nvest for giving us the opportunity to share some insights with all our attendees this afternoon. Before I hand over to Ari and Yaz, I thought it would be worthwhile to just give you a definition of what we think of when we think about thematic investing. When I joined the investment industry, we invested most of our clients' assets locally in South Africa, very little offshore, and we mainly had access to active managers. But the industry has come a long way over the last 20 years or so. We can now invest a lot more internationally. And when we look at investing, we also get the opportunity to have a much bigger toolkit. So we would decide whether we want to invest in active strategies, passive strategies, smart beta or thematic themes. Now, if you Google thematic investing, you'll see that there are various definitions. The definition I like best is one that makes sense to me. When we invest in thematic themes, what we're basically looking for as investment managers is we're looking for opportunities or themes that we believe are going to play out in the future. So rather than being backward looking, we're future looking. And then we try and determine which companies or industries are likely to take advantage of those themes and do well. So there are two things that you need to consider if you're looking at putting thematic investments into your portfolio. The first is that they should be long-term in nature. So it's a long-term trend as opposed to a short-term fad. And the second thing is the reason why you would include it. Is it going to add to your clients' portfolios? In other words, is there going to be a capital gain, or is the portfolio going to appreciate from it? And one of the things we look at to determine that is it another extra opportunity? Does it add to diversification in your portfolio? But I'm now going to hand over to our two speakers. Welcome. I think we're going to start off with Ari. If you could maybe share your insights, and then we'll do some questions afterwards. Thank you.
Sure. Thank you. Thank you, Flobela. And good afternoon, everyone. It's a pleasure to be here today. I'm just waiting for my slides to come up. If that's already up, then I'll start speaking. Thank you. So I would like to spend the next sort of 5 to 10 minutes to go through the thematic capabilities and how we approach thematics here at S&P Dow Jones Indices. And I was going to start with how we define a thematic strategy, Flobela, which you have kindly already sort of pointed out. And I think I totally agree. There's no consensus out there, and it may vary from institution to institution, be it financial, academic, or the media. And as you pointed out, more recently, it's thought of as exposures to long-term structural shifts that are taking place, be it social, technological, political, or even environmental. Now, but if we consider a broad catch-all definition, a thematic strategy is simply designed to deliver a targeted investment exposure. Now, by that definition, we here at S&P Dow Jones Indices have been involved in thematics since 1999, since with the launch of the Dow Jones Internet Composite Index. And over the years, we've been launching various indices, providing exposures to various themes and sectors, and we continue to do so. Now, as you can see on this slide that is in front of us, There are various different indices here, and I won't go through each one of them, but we are very active in the space at present, and we continue to be active. Moving on to the next slide, please. Thank you. I've also included here our involvement in ESG indices, and which coincidentally also dates back to 1999 with the launch of the Dow Jones Sustainability Indices. Now, I guess this is an area which is debatable with respect to the context of thematics. And we do see a link here between ESG and thematics in some instances. For example, where you have instances where clients who align their portfolios towards the United Nations Sustainable Development Goals, for example. So there's 17 of them. Now, we are very active in this area. It's an area that is hugely popular. And you could argue some of these areas provide exposures to certain themes or certain exposures which are aligned with sort of policies that are in place globally, for example, the Paris-aligned indices and the climate transition indices. Now, these two areas, ESG and thematics, alongside factors, are strategic areas of focus here at S&P Dow Jones Indices, and we continue to invest our resources and build upon our capabilities. And if we look at our book of work and the pipeline we've seen, particularly over the 18 months, is heavily skewed, particularly here in Europe, heavily skewed towards ESG and thematics. Now, I've given you a glimpse of some of the indices that we have built along the way. And I guess the next question is, how do you bucket them? So what we've done is we've identified 4 main areas which are commonly acknowledged in the industry as areas that are seeing structural growth. And these are innovative technology. Now, these are technology that enhances the human evolution. Now, examples would be robotics, for example. Then we've got environment and real assets. Now, this is a relatively broad area. Now, this is linked to human activities that affect the environment, now economic development, natural resources, and ESG areas that attract societal awareness. Third, we've got society and demographics. Now, these are themes that capture essentially the changes that are happening in a society and the way we live. Now, these could be consumption-related themes, for example, luxury, or religious-related themes, for example, Catholic values or Sharia indices. Now, the 4th pillar is health and wellness. This is self-explanatory, and these are sort of areas that enhance the well-being, health and well-being of the society. So, for example, you could have digital health, wearables. These are different exposures that you could gain in this area. We've got a 5th pillar here, which is multi-theme. Now, this is where when a particular theme spans across multiple different areas, and this could be a broad ESG index, or it could even be, for example, a new economies composite, which spans across multiple themes. Now, this is the way we view it, and clients of ours may view things differently. So there are other taxonomies out there. I mentioned earlier the United Nations Sustainable Development Goals. We increasingly see that clients align their portfolios towards these goals. So there are different ways we could even map our indices to these different taxonomies as well. If we could move to the next, thank you very much. Now, this I think is an important slide, and before I go there, I think it's important to state that traditionally, thematic strategies were offered by global macro funds, and it relied heavily upon human knowledge and expertise to build this exposure. But what has changed now and what has developed is the proliferation of data that is available to us, and this has enabled us to build a variety of indices that they're able to mimic what was created an active space, I suppose, before. And this slide essentially represents that. And what this slide does is essentially shows what goes into building our thematic range. And we have 3 pillars here. And the first pillar is we consider a classification system-based construction. Now here we have, for example, GICS. Now many of you will be familiar with this standard of classifying companies to certain sectors. There are 4 levels of granularity. You have sector, industry, sub-industry, industry group, industry, and sub-industry. And you could build a theme using the GICS hierarchy at various different levels. For example, you've got an all-tech index. You could pick a selection of industries and sub-industries, group them together, and build that exposure. So that's how you do it with GICS. Then we have RBICS. RBICS is a new data set, relatively new data set that is offered through FactSet. This is a partnership that we have with FactSet. Now, it's a comprehensive structured taxonomy which provides precise classification of companies and their associated businesses. Now, the added benefit of this data set is it has revenue attribution to the most granular levels within these businesses. So what it does, and it has global coverage, it normalizes non-standard reporting, and you're able to tease out a company's involvement in certain niche areas. So like GICS, you are able to build an index using this particular hierarchy, which is more granular. But the added benefit, you could use the revenue data to extract the purity of a company towards a certain theme. So that's the first pillar. The second pillar is with respect to natural language processing, and this is offered through our Kensho range. Now, Kensho was acquired by S&P. Kensho Technologies was acquired by S&P in 2018, and what it does, it has these capabilities where it goes through unstructured text such as regulatory filings and publicly available information to analyze companies and classify them into specific themes. So we build industry models that describes a certain theme, and based on that, we run these capabilities to assign companies accordingly. And this is increasingly becoming very popular. Now, the third pillar I have here is on our proprietary data offering. And I'd like to focus and zoom in more with respect to our ESG data solution. And this is powered by our ESG organization, which is called the S&P Global Sustainable One. And now this is a single source of sustainability intelligence. It has various data that we are developing and building our capabilities for a variety of different clients. But from an index provider standpoint, we use the S&P ESG scores. Now, this used to be from SAM, which used to be owned by Robeco Asset Management. It's questionnaire-based, industry-specific approach where thousands of data points essentially are rolled up into a single ESG score. We also have our S&P Global TrueCost data, which is a data and analytics platform providing market-leading climate risk data and ESG-related data sets. So this, and we have obviously various other data sets. So these are essentially, I wanted to give a very important slide where it essentially could be seen as the ingredients to building our thematic indices. And it can get really powerful if we mix and match these capabilities and build the offering. What we could do 15 years ago is very different from what we can do today. And if we could please move on to the next slide. And it's essentially, this slide is very quickly, how do our clients use our products? And, you could simply take what we have on the shelf, or we've seen many clients where they've taken existing indices as building blocks to put them together to build index of indices to gain a specific broader exposure. And or finally, if we don't have what they want on the shelf, we can certainly leverage the capabilities, the slide that we've just gone through, to build something from scratch that works for them. And I'll leave it at that. Thank you, Flabella.
Thank you so much, Ari. That was most informative. We've had a couple of questions from the audience. So before I hand over to Yaz, if you'll just allow me to ask you two questions. The
Sure.
first is, would you classify ESG and multi-style as a thematic or separate branch of investing?
So it's an interesting question. And I think when we talk about ESG, we have multiple flavors of ESG. Now we have exclusion-based ESG indices, for example, the S&P 500 ESG. Now, I wouldn't consider that really thematics, but then we have, as I mentioned, other flavors, climate-related ESG indices, for example, the carbon efficient, Paris-aligned indices. Now, this, I guess, is getting closer to the line of thematics. You're trying to gain a certain exposure, but you do have very specific theme-based ESG concepts as well. Clean energy, for example, is an ESG-related theme. So I mentioned earlier about the United Nations Sustainable Development Goals. You have various goals there that relate to water scarcity, clean energy, infrastructure, biodiversity. So that the various aspects there which are very tied and related to ESG, where you'd consider those definitely thematics. Now, with respect to multi-style, I'm assuming you're referring to multi-factor indices.
Yes, sorry, multi-factor.
In that respect. So now, if I think what a multi-style or multi-factor index is essentially to deliver a diversified exposure to multiple factors, for example, quality, value, momentum. And what that does is essentially gives you a broad diversified exposure with the lower risk. And I think this probably is less so of a thematic. If I think of a thematic and how it fits, and go back to its definition and how it fits in the portfolio, it could act as a diversifier to a core portfolio, whereas the multi-factor itself is the diversified exposure. So I think that's a bit debatable, but I'll be keen to hear what Yaz thinks about it with his expertise.
Yaz, should I give you an opportunity to respond to that?
I'd actually agree with a lot of what Ari was saying. I mean, you basically have to think about it as when you think about multi-factor investing, it's really about capturing risk premium embedded, and there are decades of academic and empirical support. So it's very different from the forward-looking expectations of thematics. So we'd argue that, for example, multi-factor might be more part of your SAA design, whereas thematics is kind of a shorter term horizon. On the ESG intersection with thematics, I think Ari's absolutely right. When you kind of go from, it's actually very, very broad, and that investors are actually looking at incorporating ESG across their entire portfolio. But absolutely, it's linked to thematics in the context of environmental, in terms of social, in terms of the UN SDGs. And a lot of themes that are actually gaining a lot of popularity are actually in the ESG space. Ari mentioned climate change solutions, for example. So I think I'd actually agree with a lot of what you said.
Okay, thank you. For our South African investors, we've also had a couple of questions. So ESG, the E stands for environmental, S for social, and G for governance. And in international portfolios, there are a lot more opportunities. So because the investment landscape is so much larger, you can actually exclude investments into things that do not have ESG factors. In South Africa, our universe is fairly small. So if you were only trying to identify investments using those factors, you might not have sufficient choice. So I think maybe one of the things that we look at Momentum Investment Consulting, when we put portfolios together, we also do subscribe to the United Nations Principles of Responsible Investing, and we look at the ESG factors as well. I think one of the things that we probably need to look at when you look at investments, it's not only about having access to those and diversifying, but when we then measure it, should we be measuring the social and environmental impact beside the actual fund return? Ari, do you think you need to measure both?
So, sorry, if you could repeat your question there. So your question is specific to social or the individual pillars measurement.
Correct. So when some investment managers come back, they say, well, the fund hasn't done well, but
Right.
we have invested in these ESG factors, so we're doing what we're supposed to be doing from a diversification perspective. Now, I would argue that you need to actually measure the social or environmental impact in the different pillars, as well as the fund's return. Both are important. Would you agree with that?
Yeah, I would definitely agree to that, and I think there's another aspect to it. I mentioned about earlier thousands of data points rolling up into a single ESG scores, and it's really how you go about employing. Let's say we're talking about gaining a specific exposure to an ESG tilt or some sort, and we need to determine. I guess this is where you separate between a sort of a tilt exposure versus a more thematic specific exposure to a certain area, for example, socially, right? So now coming back to my earlier point, when you roll up all the data points to a single score, you have the impact of averaging that is occurring across all the different data points, and you need to find a way of selecting by using some sort of metrics, and you do have certain instances where a company may score high on a couple of pillars but on lower on another, but the averaging effect may lead to a higher score. But so on an overall basis, you can assess a company with respect to its scores and how it's performing, and I guess performance is a different, how it performs overall is a different question altogether.
Yeah.
But if you're looking specifically to certain pillars, then I guess you can drill down and select sort of companies that score highly against these pillars, and you hope that these will play out over the long term.
Great, thank you. I think if we can't measure, it's very difficult to explain to investors why you're invested in those strategies. But thank you for that. Excellent insights. Yes, I'd like to hand over to you now and give you an opportunity to talk us through your styles and how you think about thematic investing.
Great. Well, thank you, Flora, and thank you to everyone for inviting us here and giving us this opportunity to share our insights on thematic investing. I think in this section, what I'll do is I'll just offer some initial thoughts on two key aspects of the topic. One is where the demand for thematic stems from, and also where might it fit in within a portfolio. And then secondly, to share some thoughts about about our approach to building thematic exposures. And you'll see some similarities with Ari's work, but obviously we come to the problem from an active perspective. So it'll be interesting to contrast the kind of the similarities and the differences. So first of all, what is driving the growth of thematics? I think we've seen an increased interest from clients in thematic investing. I mean, that's a truism. They are looking for more focused exposures to particular trends. In the introduction, Bella mentioned that these can be economic, demographic, or environmental nature, but really there's essentially you're capitalizing on some element of growth. And that's kind of the core need for an investor is what you're actually allocating to here is something that you believe is a driver of growth and therefore return, and also provides diversification across your portfolio. But Ari mentioned one point which actually is also important, which is sometimes thematics is simply allowing clients to align their investments with their values or convictions. He mentioned the UN SDGs, for example, and I'd actually say that is an important driver in addition to the growth aspect. So in each of these cases, investors are really looking to invest in a portfolio that maximizes their exposure to that particular theme. So I'd also make the argument that the growth of thematics in recent years represents the ongoing evolution of investors, or perhaps more accurately, I guess, an asset allocator's toolkit in terms of building more granular portfolios. So what you see in this slide is kind of the evolution of thinking in terms of how an investor increasingly better understood the potential drivers of the return in their portfolios over time, how we've evolved in analyzing the exposure in our portfolio. So when you think about kind of analyzing sector exposures, we're fairly comfortable with that. I mean, we've kind of evolved from that to a certain extent, that we've understood that there are certain risk premia. We mentioned that, for example, ARI has factor indices, and accepted that actually because there are risk premia there, we actually would potentially want to include those as part of our strategic asset allocation. And then you might want to tactically move around that. But I think essentially the next step is evolving that one step further and understanding also the thematic exposures that might be embedded in our portfolios, and therefore using that information to ultimately build better portfolios. Now, related to this is the whole issue we discussed around values or convictions, and that is an important driver in the growth of thematic investing, which is a shift amongst end clients to being able to allocate capital in a manner that is less focused on traditional geographic or sectoral exposures. And that is particularly true for the younger generations. So in surveys, it's often been shown that they have a much greater predisposition to thematic investing than the market overall. And part of that is actually a values alignment. So now if I take a step back and think about us in terms of our approach in thematic investing. So if we go to the next slide. So in the quantitative solutions team at JP Morgan Asset Management, we've spent a significant amount of time over the past 3 to 4 years considering how best to meet this increasing demand from clients for thematic strategies. And it's resulted in the launch of a number of thematic strategies covering a range of topics from disruptive technologies. I think when we actually think about the 3 broad areas: disruptive technologies, people and demographics, and sustainability. And these are kind of similar to the very broad brush themes that Ari mentioned before, and Plavella included when she first talked about thematics. So as an asset manager, I'd say our value proposition is really focused on the combination of a few things. One is leveraging powerful technology, AI capabilities, and you'll see some similarities but some differences from what Ari spoke about, but also leveraging fundamental insights that come through the broad company research platform, basically our active equity analysts. And so kind of being able to bring both to the creation of and management of thematic investing, we believe is actually a very powerful proposition. So if we go to the next slide, I'll start by talking a little bit about our AI engine, which we refer to as ThemeBot. So this is an AI technology that underpins the data element of the process. So ultimately, on the surface, it's actually similar to some of the things Ari mentioned, but I will go into a little bit more detail around how it works, so you can see the differences, because, I mean, he actually gave a decent amount of information there as well, which is good. So ultimately, it's also a natural language processing engine. And clearly, it provides a very highly scalable and customizable framework for thematic investing. But some of the unique things that using a tool like this is brings to the table that potentially another traditional active manager might miss is, so ThemeBot is able to uncover smaller cap pure plays, for example, that might not be in the coverage universe of a traditional analyst team. I'd also argue that it can think outside the box to a certain extent, where sometimes we find it suggesting names that are not obvious at first glance, but once the analysts then do a little bit more research on the, and actually one very important point of artificial intelligence is that often AI tools are black boxes. And so we've built this to very much be something an analyst can interact with. And so that, so what happens is that if you get something that seems a little bit orthogonal. The analyst looks at it, can actually see the data that the AI engine throws out as saying, this is why I've decided that this stock is relevant, and then determine whether it is indeed the case or not. And that's actually we found it to be quite valuable, an additive to an analyst's toolkit. Naturally, of course, using a tool like this improves time to market, as elements of theme creation that traditionally would have been done manually can now be replaced with the power of AI and machine learning. But if I just spend a moment about how ThemeBot works. So ultimately, it ranks stocks on two metrics. So the first metric we refer to as textual relevance, and the other one is revenue relevance. So that you can kind of see the similarity with some of the work that Ari was talking about. So the first phase uses natural language processing to create a mind map. So what you see on the left-hand side here is actually the mind map of words and phrases related to the theme. So if you're looking at renewable energy, it's going to say, solar, wind, and so on. And so it just the first pass of the AI engine is to essentially tell you all the terms and phrases that the engine believes are related to the theme that we're actually looking to create. And at this stage, we engage with our sector specialists to further refine the AI-produced mind map by incorporating terms, for example. If I just mention how these terms are created. So behind this engine is tens of millions of research and articles that come from broker research. So you've got two actually primary sources of data as well as secondary sources. So when you think of primary sources, we're basically talking about company reports, regulatory filings, broker research, and then secondary sources are things like news articles. And we've got 10,000 news sources, including multiple languages as well. So the first, in order to create the mind map, what it's actually looking for is you put in a seed query or as detailed as you like, and then it will go and find terms and phrases that co-occur with your query most often, and those would be the terms and phrases related to the theme. Then our sector analysts work with this mind map. They further refine it, and then actually, interestingly, as they're refining it, the AI engine kind of learns from that refinement and actually then suggests other terms and phrases. So it's kind of a two-way process between the AI engine and the sector analyst until we come to a mind map that we're happy with. And then the next stage, once we've done that, then we actually generate the textual relevance scores and the revenue relevance scores. And what it then does is it's essentially looking at every single stock, how often do terms and phrases related to that theme get mentioned, related to any particular stock relative to others. And then revenue, it looks at basically how the company breaks down its revenues, looking at different sources, including actually the same sources that Ari mentioned as well as others, in terms of trying to attribute how closely linked that attribution is to the theme. Now, it's very rare that you can find, actually, if the theme is very well defined, like renewable energy, it'll actually be easy. But sometimes when the theme is less well defined, it's actually harder to map the Arbix breakdown, for example, of revenue back to the actual theme. So we've developed a probabilistic measure there as well. And then so then it creates your top stocks, and then that's the next phase in which we engage with the analysts, where they actually look through the stocks individually, verify the information, and then finally, of course, the portfolio construction. So this kind of creates the first pass of our portfolio, which is the AI engine. But we do believe that a significant advantage of being a firm like JP Morgan Asset Management is actually being able to leverage the insights from the analysts as well. Now, clearly, even as part of the AI process, we leverage the analysts. But then the next stage, once we've created the top ranking names to the theme, is you want to integrate fundamental data, valuation, quality metrics within the portfolio construction, or the insights of our large global equities analysts, and kind of how important that that aspect is also kind of driven to a certain extent by the breadth of the theme itself. So finally, in terms of portfolio construction, there are a few points that we'd focus on. So there's a balance between ensuring adequate diversification, because you don't, I mean, ultimately, when you're looking at thematic investing, you're looking at capturing the theme. So you don't want idiosyncratic stock-specific risk, I would argue. But at the same time, you also don't want to kind of hold every name in the theme. You want to make sure you're holding the best names in the theme. So the other thing is themes tend to have a growth bias. So, for example, I mean, we talked about multi-factor stuff, and of course, value is a risk premium in itself. But themes, because you're actually trying to capitalize on an element of growth, most themes tend to have an actual growth bias. And so it's actually important in the portfolio construction to take fundamental metrics into account, take leverage metrics or quality of earnings or even valuations into the portfolio construction. And then finally, you want to be able to capture the smaller pure plays. So one advantage in having a fund, for example, is that it can be close to new assets. So you can kind of really allow yourself to remain exposed to those smaller pure plays, or at least in an, I guess, more open-ended vehicle. Then you need to make sure that you ensure appropriate liquidity and weighting methodology, so that you allow the small caps to come in, but, for example, you maintain appropriate liquidity for the vehicle. So that was really everything I had to say.
Great. Thank you very much. So I guess my question for you is, does valuation matter in thematic funds? In other words, if you've had a massive rally in a particular sub-theme, should you downweight it towards a cheaper theme, or do you think you just let it run?
So actually, interestingly, one area of focus at that point that we've been working on is actually developing a framework around return expectations around the theme. So by adapting, I mean, we have at JP Morgan the long-term capital markets assumptions framework that and adapting that to kind of apply to thematic investing. So you kind of bring the macroeconomic work of our strategists with the bottom-up work of our sector analysts. Because absolutely, a theme can be expensive. And so you do want to actually monitor. And actually, this is, funnily enough, one area where you can actually bring multi-factor and thematics together, where you actually also look at the multi-factor how do all the different themes look like from a factor lens, and is it expensive relative to where it's been? Now, they'll generally look expensive relative to the broader market. That's not necessarily an issue, but the question is it might look expensive relative to itself or relative to other measures. You kind of want to make sure that you have appropriate measures to look at themes, because just like any other asset, it will go through cycles.
Thank you. I think that's an excellent answer. One more question for you, Yaz. In terms of the appropriate allocation, so you've touched on it now briefly when you answered the question, but I think when you're deciding whether to include this, you can obviously look at thematic from a strategic asset allocation. You first decide which asset classes you want to be invested in. Secondly, which styles or themes you want to have access to. How do you then size the correct amount to a particular underlying strategy or theme or sub-theme?
So that's interesting, because I mean, ultimately, if you're thinking about it in the context of strategic asset allocation versus tactical asset allocation, I mean, thematic investing kind of sits between the two in terms of a time horizon. So that kind of already gives you a hint of how you would look to weight it in the portfolio. An SAA, strategic asset allocation, typically a 10 to 15 time horizon. That's part of your strategic framework. And actually, if you multi-factor, because we believe they drive a risk premium over time, will be part of the strategic allocation. Now, that will probably mean that you'll have a higher leaning to those. GTA on the other extreme, kind of global tactical asset allocation, is kind of much more shorter time horizon, 6 to 12 months. So thematics kind of sits in the middle. We'd argue 3 to 5 year view on average. Although it does depend on the theme, because I mean, I really like your definition of the theme in the beginning, talking about it being much more medium term, much more disruptive themes. Because I mean, some people would incorporate shorter term trades as themes, like for example, the reopening trade post COVID. That is, I guess, a theme, and a macro manager might put that in their portfolio. It's much more shorter term. So I'd argue that that's a trade rather than a theme, but some people do put that under the thematic lens. If we're focusing on the medium term, then ultimately you're kind of looking at 4 core characteristics for allocating to a theme within a portfolio. You're basically kind of the weight is essentially going to be between your TA and SAA, because it's not quite an SA, but it is much more medium term. But you need to make sure that you've got 4 things. One, that it's distinct from macroeconomic noise. There's actually a persistence to the theme itself. It's permanent, i.e. it creates a step change in earnings, valuations, to the companies involved. It's disruptive, so there should be clear winners and losers that are identifiable. And actually the 4th one is that it's identifiable in the sense that it's specific enough to credibly tie economic impact to the securities in the portfolio. And those are really the kind of, I guess, the core attributes that determine the strength of allocation in the portfolio. And then in terms of weighting, I'd say it kind of sits between SA and TA.
Thank you. I think we've covered most of the themes, and I know that we're running out of time. I do have a couple more questions I'd like to ask you both. One thing I wanted to add for our investors that are attending this afternoon is that in South Africa, even though thematic investing is fairly new in comparison to some of the offshore providers, it is something that's been in existence for some time now. And when we put together portfolios for clients, we do include these factors and look at them firstly from a strategic asset allocation perspective. So where do we think we need to be invested for the long term? But as Yaz correctly said, when you find opportunities in the short term, there's an opportunity to also tactically tilt your portfolio towards those. Since this is a 1nvest session, the 1nvest S&P 500 Infotech a fund, which focuses in the US, was launched about 3 years ago. It is a first-generation thematic type of fund. Obviously, since then, it's evolved, and we're now looking at more specific sub-themes, things like clean energy. And I think whatever the strategy is that you're using, you should always be looking at how the portfolio as a whole has performed. So risk is important. You can't not consider risk in the portfolio. And I guess you'd also want to make sure that after investment fees, you're still outperforming, regardless of how you're constructing portfolios for clients. Ari, if I can maybe ask you, what do you think the major themes are likely to be in the next sort of 3 to 5 years?
So I think the way I'll answer that, Flabella, is to bring our Kensho offering, specifically the Kensho New Economies Composite, into the picture here. And it is built based on a completely new taxonomy, based on new transformative industries that are propelling what we call the 4th Industrial Revolution. So what is the 4th Industrial Revolution? And this is actually a term that has been coined by the World Economic Forum. It essentially goes into describing the technological revolution journey that we are on in terms of the way we work, the way we live, the way we relate to each other. And they define each of these revolutions from the first to the 4th, and the third revolution being the introduction of IT and electronics to automate productions. And this 4th Industrial Revolution builds on that in terms of digitalization. And the speed at which the breakthroughs are happening, the impact, the scope, it seems to be impacting every industry in every country. So if you think about the jobs we do, it's robotics, the food we eat, sustainable staples, the way we travel, autonomous vehicles, the power we use. You mentioned clean power, and how we protect ourselves, for example, cybersecurity. So I guess my answer to that is you almost the way where this index or this family of indexes is structured is based on a completely new definition of what sectors are, and it basically redefines what we traditionally describe as sectors, and you always have this sort of evolving forces globally that disrupt industries, and so I suppose that I hope that sort of answers your question, Flabella. But
it does. Thank you.
I see this taxonomy as a way of addressing that question.
Great, thank you. We've got time for one more question. Yes. How do you think about cryptocurrencies? It's obviously been very topical in South Africa and internationally. We've seen some new rulings coming out. How do you think about that? Is that a theme? And is there space for that in thematic investing?
I mean, it has. We have seen it come out. I guess to a certain extent, one can define it as a theme. To date, we haven't actually used them in our portfolios or launched anything in the space. It's certainly something we continue to monitor. But I will actually, and this is kind of my personal view, but I will mention one thing on this, which is actually the environmental impact of cryptocurrencies. I mean, one of the biggest themes I would argue right now is actually sustainability-based themes. You know, the pressure to move to net zero is creating lots of disruptive forces, and investing in companies that are part of the solution to climate change is probably where a lot of that the returns will come from. And I think Ari mentioned that quite eloquently. And when you think about crypto, the issue there is that actually the mining of the coins and also the maintenance of the blockchain is actually extremely energy intensive. We've all heard that, for example, today, just today, when crypto is very much a marginal asset, it already uses more energy as Ireland or Singapore. And if this becomes more mainstream, you can see that actually, I think there are estimates that potentially it could double the Earth's energy usage if it actually became a major currency. And so that kind of really tells you that it goes against one of the biggest trends that are taking place. And without solving that issue, I think it'll remain a bit more limited.
Thank you. I hope that you can all see that investing has become more complicated, not less. And increased toolkit just means we have so much more that we need to analyze. So there's so many more opportunities, and with it comes risk. But I think the most important thing, thanks to both our speakers for sharing your insights, I think the most important thing is about values. So when you're asking an asset manager to put together a portfolio for you, does it tie in with your values and what you're trying to achieve as an outcome? And thank you to 1nvest for giving us the opportunity to look into this in a little bit more detail. Thank you both, Ari and Yaz.
Wow. Thank you so much, Flabella, to you and your panelists this afternoon. You know, on that closing note of unpacking complexity, I really enjoyed your session and the panel, because we do see these key themes making an appearance. We see these new trends. And of course, you know, we're all trying to find different and practical ways, of course, to apply them in various environments and for various reasons. So as much as it's also complex, thank you for that unpack, and hopefully through a lot more collaboration, communication, and of course, just the environment taking on some of these new ideas for more responsive products. We're going to see a whole new world and a whole new ball game, in index tracking funds as well as in asset management. So thank you to all of you. Ladies and gentlemen, let's unpack at this point in time the results of our very first poll. They are now up on the screen, and thank you to all of you you who have continued to post your comments as well as participate in these polls this afternoon. Of course, what this will allow us to do is just gauge, of course, some of your insights and make sure that as we unpack more of the themes this afternoon, we're able to be better responsive to the issues, the priorities, as well as some of the critical practicalities that you're all dealing with at the moment within the sector. At this point in time, we'd like you to take a look at our screens again, and we have a second poll up now. The second poll specifically refers to the issue of thematic investment. Is this a fad or is this something that is here to stay? Let us know your thoughts. And of course, our chat function on this webinar remains available and open for you to share those thoughts as well as any additional questions you may have for our guests. Now, in my very next panel, ladies and gentlemen, I'm going to chair this particular conversation, and we're going to take a very specific look at the role of technology in the advice process as well as the value chain as a whole. Now, we've all just come through perhaps the most difficult 18 months of not just this country, but also the rest of the world's day-to-day economic activities and daily activities. And certainly quite a number of traditional practices, have been thrown right off any regulatory axis or basis that they were founded on. And there's a new world order for us to respond to in each and every single sector, including the one that we're interested in here today. Good afternoon to my panel, and welcome to all of you, and thank you for joining me on this next discussion. Ladies and gentlemen, my very first panelist who is sitting next to me this afternoon is Kagiso Mahura, who is the Chief Executive Officer and an Executive Director of Greatridge Mahura Investments. Welcome to you.
Thank you.
My second panelist seated in the middle is Ms. Georgina Smith, who is the Head of Distribution and Sales for Innate. And my third panelist this afternoon is Adam. Good afternoon. Adam Godlich, who is the Executive Head of Behavioral Science at Standard Bank's Client Solutions. Welcome to you too. Well, let's kick off with, really unpacking where particularly our industry, the South African industry, finds itself at this conflux, both in history but also in practices, trends, and creating a responsive market to both investors but also on the client side. So as we really kick off our conversation this afternoon, Kagiso, I'm going to start with you. And I'd really just like you to give me a sense of, for you, what have been some of the seismic shifts you've been following in the last 18 months in the industry as a whole? And what are some of the key issues and priorities you are going to be following as we move forward? I think particularly into the next 18-month horizon that we have before us, but very much into the next 5 years, which is sort of the horizon that the balance of this conversation today has centered on.
Yeah, good afternoon, Lynette, and thank you very much for that. I think for us as a business and as an industry, so I'm going to use our business as an example of how things have changed, particularly as far as technology is concerned. Last month as a business, we were awarded the FPI Practice of the Year, a professional practice. But what is important about it is how much that conversation and the due diligence was based on technology. So I think from our perspective, it helped us to look at the role that technology plays in the advice space. So I think we then kind of put in 3 pillars in our practice as to where technology plays a role. So we kind of said, there's what we call the functional and operational side of technology, which is just based really on our compliance processes, the CRM systems that we have. And then we kind of have the second part, which is the more technical side, where we do all the analysis and all the tax calculations and all of that. So it's a different type of technology, which has got to evolve a little bit quicker. And then the last part, which is really where the seismic shifts have happened, is where we call the client interaction side. So which is where we deal with clients and speak to them on a regular basis, because now not only do we have to change as a business, but our clients need to change and adapt as well. And I think we can spend a bit more time maybe chatting around that.
So would you say, Kahisha, from your perspective, the role of big data has moved from very much a futurist type of theme and topic in asset management to really what is critical to implement into your practices yesterday?
Yeah, look, let me put it to you this way. The big data story is kind of catching up with that as far as the industry is concerned. The big shift for us, I mean, we just looked this morning at just the reviews that we've done with our clients. 45% of our reviews this year were done by MS Teams. 40% were done through email. So only 10% of our clients over the last year have we seen actually face-to-face, which means they have had to move into the data space. They've had to use technology a little bit better than they've ever had to use it before. So we definitely look like we're never going to go back, but we definitely moving forward.
We're going to start to move forward. All right. Thank you so much to you, guys. So, Georgina, I'm going to move straight through to you. And we've actually had quite a number of really interesting conversations, especially just around how technology, the pandemic itself, your entire value chain has changed over the last 2 years. It's a whole new world and a ball game. One of the things that certainly the pandemic did for every industry, including this, is that it highlighted both the limitations but also the massive opportunity to grow one's market share and reach through using technology as almost the differentiator, but also the great big equalizer, as it were. Just some of your views in terms of, technology being a new bridge, but also being a possible impediment. Robo-advisory, based on Kagiso's answer, it is a future that is not going to change and is not likely to regress at this point in time. But similarly, brand new people you've never met, brand new relationships to create, robotically, as it were. What has this meant for the industry, and what have been almost the points of consolidation or the drivers, the new drivers, the accelerated drivers at this point in time?
Wow, Lynette, what a big question. Yeah. Thank you, and thank you very much to 1nvest for having me on today. I guess, being part of Innate being part of the platform world, I've spent the last few years on the Innate team building an advisor-inspired platform, if you like, which is very much our kind of our USP. Many platforms, in fact, every other platform pretty much out there is a sort of butchered either bank system or Lifeco system. So to be able to start from scratch and build it from the bottom up with what the advisor actually wants has been a real treat. And we've really loved engaging with advisors to do that. So when we talk about trends and really what we're trying to do, actually, COVID was in lots of ways it was difficult and hard and all of those awful things we have come to associate with COVID. But from a technology perspective, it's been great. It's accelerated adoption in the advisors' world, in Kagiso's world. Clients are now quite happy to engage on Zoom. We've seen movement of advisors to areas where they want to live and remotely advise their clients. I've seen quite a few move down to Plet. I've seen quite a few move to places that they would like to actually advise from. So actually what you're seeing is some quite seismic shifts in actually how advisors want to serve their clients. And then if you go into the robo-advice side of things, which you mentioned earlier in your question, well, that's also interesting as well. And robo-advice is not really that present here in South Africa. I mean, my job is very much to understand technology, very much to help build solutions that are going to enable an advisor's client value proposition, really. That's what I'm here to do. And so to understand what his challenges are and what he's trying to actually put in place in his world and therefore what his trends are is part of my job. So robo-advice, I don't see coming in the way that we've seen it in other markets here, but I do see something of a hybrid model, which I think would be very beneficial to advisors and clients alike.
Oh, wow. So thank you very much, Georgina. And I think, as we move to the context now of where the advisory is coming through a machine, but you're still saying that there's still a very big place for the personal touch. Adam, I'd love to move to you. Now, in the past, anytime in the financial services sector, anybody perhaps spoke about behavioral science, it probably came from human resources or talent. Now we find you in a very different role where you're now having to, analyze, track, but also develop responsive solutions to, the intuitive, almost human nature of these machines. And of course, helping advisors like Kagiso and Georgina here create natural language practices and really bridge the gap between man and machine as the two converge in this particular space. We've all, when we typically follow asset management advice and we look at the markets, have relied on trust-based relationships, almost as a lead and a guide to the integrity of the advice that we also receive. And of course, because industries are regulated, there are sets of rules and rule books to play by. And of course, the statutory regime around all of these things, they've always been these safeguards. Tell us now how these traditional practices, this very linear, guided, regulated, crossing of T's and dotted I's world is now having to also take into account how behavioral science, the human being with its flaws, its errors, its thoughts, its forever changing patterns, coming into that world. What does this now mean for you in an industry that's always been very systematic, very much based on evidence, the numbers at the bottom? Tell us more.
So it's a big question, I think, as well, but a good question. So firstly, I think behavioral science, we understand a few things about customers and about people in general that I think are you can't argue with it at this point, given the amount of evidence. So we know that people are irrational. We know that people don't have stable preferences, and we know that we constantly make decisions that undermine our own utility. So given this, I think the challenge is to take a realistic view of human beings and customers, right? We are flawed decision makers and we're comparison machines. We love to make sure that our decisions are made in context. And as a result, I think there's been this wave, maybe that's a poor choice of words, but certainly this trend of now looking at individual consumers as people rather than the assumptions that we have about people in general. So over the last 18 months or so, and I think you made reference to it, and Georgina, you definitely made reference to it, which is that, people are starting to change, but there's two distinct categories that people are falling into at the moment. So the first one is that you have like this needs must group. So these are people who, as Kagiso said, 45% of their reviews have taken place, online or in MS Teams. So you have people who are just adapting to the current environment as it is. But when things start to sort of go back maybe a little bit, regress, they'll fall back into old habits. Then you have the other group, and the other group is sustainable adopters. So people now who like the way things are, advisors moving down to Plet, and really do want to bed down this change, comfortable with it, and you'll start to see behaviors emanate from this. So you'll start to see that not only are these sorts of customers more likely to engage more frequently on digital channels, more likely to probably engage with something like robo-advice in the first place, and what you're likely to see is a new means of engagement with these customers that's required, which I think is very important and very interesting. And this is not just happening in this field, it's happening in every field. If you look at, a company like Peloton in the US, right? So their shares dropped about 35% on Friday. And at the same time, Planet Fitness has seen their shares climb to the highest levels that, they've ever seen. So you're seeing in one instance that, customers are starting to regress and going to old habits, but there's still a sustainable amount of them that are adopting these new behaviors. And I think what this means for us from a behavioral science perspective is it's about saying that you really do have to focus on consumers as like a segment of one, right? That's what big data really should enable. It should enable personalization at that level, such that we can understand people's innate irrationalities. We can understand that, as investors, we're our own worst enemies when it comes to realizing returns, and start to create strategies and platforms that enable this understanding as opposed to trying to work against human nature.
Okay.
And I think that's really an interesting place in which to play over the next coming, months and years, which is to say, let's take a realistic view of the human investor, understand this, and build for them, as opposed to having them fit into what we have.
Okay, Kariso, back to you, based on the answer from Adam. What does this mean for you, the fund manager now, specifically in terms of client fulfillment? You too, on the other side of the machine, and on the other side of the virtual table with the clients, are an advisor with a limit of resources, time, products available, and now almost with infusing behavioral science into a new approach to asset management, where you are also being asked to be personalized and customized, and these new solutions that talk to me specifically and not a broad range of me's. What does this mean to you now from a fulfillment perspective, the type of operations that you have to run? And have you seen technology try to catch up now on the service side with helping you deliver what the sustainable group of adopters will want to see going forward?
Yeah, thanks for that, Lynette. I think earlier when I said we are catching up with big data, big data is catching up with us. I think where the evolution needs to happen, it will happen on our side, is that at the moment, technology developing functionally, but the intelligent technology is what needs to happen for us, so that actually as advisors, we graduate to actually being advisors and managers of human behavior, because the technology will take charge of the investment returns and those type of things. That's not what the clients are looking for. We need to manage human behavior. So in other words, our practices need to develop to a point where I come see you, that I need to know what type of behavior you display. So when I come talk to you about last year, COVID happened, market dropped 20%, more than giving you the technical information, I need to deal with the kind of human being you are and how you react to a market dropping 20%. And that's what my role needs to be. Not to come and churn out numbers and talk to you about those type of things, but really for the technology to give me the kind of information that helps you manage your own behavior so that you don't lose value in the market because nobody's helping you understand. Because the technology is not, it's going to take a long time to take you to a level where you understand how you need to behave. That needs to be my job.
So your profession really is changing to one that's moving to one that's very service orientated, client orientated, to one that's now very much driven by the consumer, and you then now needing to respond to these trends, to these patterns, as well as to what it is that we fundamentally need.
Absolutely, because I think a lot of advisors are hiding behind the technical stuff. At the moment, we dazzle clients with jargon and with all sorts of funny looking things, and we sound intelligent. But really, that's not what the client really needs. Because a lot of us leave our clients and they don't know what we said, but because we sound so smart, they're going to let us deal with it. But that time is going to come to an end because all of that information is going to be readily available. Our value add is going to have to be completely different.
So a little bit earlier, just to Khekiso's point, Georgina, and my next question is for you. I really opened on the issue of trust. And just, we trust you when you dazzle us with the jargon. We trust you with the numbers. We trust that because they say you're the professionals who can make it happen and ensure our returns, that's what's going to happen. Now, the issue of trust is one, I think, particularly in the social contract between societies and their economies, their governments, just their ways of being is one that has been specifically highlighted by the pandemic. We saw quite a number of movements during the pandemic spawn out of different circumstances, different locations, different socio-economic conditions as well. And I think what it's also then specifically done for business in particular is put a very, very big focus on, what is your definition of a socially responsible, investment or entity practices? What are your definitions of how it is that you're going to be seen to be applying your ESG strategy and policies? Now, as we were also listening to the previous panel that Flobella was just talking about, there were quite a number of key and catch themes and phrases that also came out of that conversation, which also now show that there are new indicators, new metrics, new measures that are coming into a space that had always been very governed by very clear, documented and evidence-based themes, but now we're also having to bring in this very social context. Can you perhaps share with us as an audience just some of the key themes, particularly in that realm, that you are beginning to see that not only now bring together man and machine, but also bring together, the system and the asset managers world with the need to be a socially responsible corporate citizen, as it were?
Yeah, no, delighted to, Lynette. And Kahiso, thank you so much for being so honest about sounding intelligent. I think that's so refreshing for clients to hear as well. The role of advisors is becoming more and more a financial coach and a lifestyle coach, as opposed to putting up graphs of PE ratios. So yeah, I think this is a fascinating question, Lynette. And I can sort of point back to answer it to a recent webinar I hosted with Rian Singh from PwC, and I'm not going to pinch his ideas. I'm full credit to Rian for doing all the work on this. But him and his team came up with 8 key themes which are going to really affect advisors over the coming 5 years, if you like. And you can see that webinar, by the way, on our Innate Connect website, just in case you're interested in it. It is actually a very, very good webinar, though I say so for myself. But I think in light of what we're discussing here, 2 of the themes are really kind of hitting home for me right here. And the first one is what you talked about, Kahiso, which is scalable, bespoke advice. How do you get that really bespoke feeling? And it's not just about the investments. It's not just about the advice that you give and the products that I put you in. It's about how I engage with you. It's about what conversations we have around the life choices you're about to make. It's about how much information I'm able to give you. If you're, how much is a child going to cost? If you're thinking of having a child, if I'm thinking of doing a side hustle, how am I going to sort that out? So I think that's a really interesting theme, which I think is coming out. And I think the challenge for advisors is engaging with clients in the way they want to be engaged with. And then the second one is the ESG, or sustainable investing, as it's given all sorts of names, isn't it? And it was spoken about a lot on the last panel. And there's definitely a trend coming strong and fast about, with clients wanting to, help make the world a better place. Having said that, I'm really keen that we don't leave this with some move on with some romantic idea that millennials, Gen Y, Gen Z, they're all wanting to change the world. When you look at Greta Thunberg after her COP26, she's only got 13 million Instagram followers, whereas Kylie Jenner, Kim Kardashian's younger sister, has got over 220 odd million. So let's not kid ourselves that this is the younger generation are really going to come and save the day. It's actually on all of us. And you're actually seeing that move towards sustainable investing across all sorts of generations. And I think we'll see more and more of these conversations, and I think financial advisors will be asked more and more in the future to be able to justify and show metrics in terms of how they're actually investing in a way that reflects the value proposition, the values of their clients that they're actually serving. So I think that's definitely going to become a theme, which is important.
So, just a follow-on question around, the values of their clients, and particularly, back to Adam's point right at the beginning, the human is flawed, erratic in their decision-making, and often quite obstinate that their answer is the only answer and the right answer and the most important answer. These fragmented values, what does it now mean for you as an asset manager, sort of bringing them together? What do you focus on? Do you focus on perhaps creating a niche of values and then associated products and services that you specifically want to talk to? Or do you try to address them all? Because I think one of the things we've definitely seen is that across generations, across geographical locations, across regulatory environments, our values are just a whole other think forum on their own.
Yeah, I mean, it's interesting, isn't it? I think actually the challenge is for the financial advisor to really understand what they stand for.
Yeah.
What's their USP? My job as someone who is running a platform and looking to get that rolled out into their world is to enable their client value proposition. So whatever it is that they stand for, I need to make sure that I can actually, make it happen from a technological perspective. So really, I leave the asset management side to the fund pickers, if you like, and DFMs out there who are doing a super job. My job is to enable it and enable their client value proposition and actually get it working for them.
So let me pose this question to the both of you, gentlemen. Let's go back to basics, and I think we are definitely trying to separate the fads and the fundamentals as part of this conversation. The basics of the world of asset management and the different funds is that you're all operating in commercial enterprises, founded for profit, ultimately, founded also for returns, and founded for sustainability. And I don't think that is going anywhere, irrespective of what happens to our values or impact or technology for that matter. Now, bringing in some of the new trends, some of these new patterns that we are having to holistically think about in the space and in the field, means that many of your traditional measures and markers at the bottom of the trial balance, the balance sheets, and the income statements are now changing. We have had, we've gone through triple bottom lines and the like. And now we're going to have to also measure very fluid, very intuitive, very artificially intelligent outcomes. And I won't call them numbers. I'll call them outcomes. What does this mean for the industry as a whole in terms of, whether how you benchmark yourselves against your peers in the industry, whether you're benchmarking performance, whether you're trying to report to, a statutory or a regulatory body as well, whether you're looking at your accounting or your banking systems, and ultimately policy and regulation. Where is this going to go? Because who gets to decide which measures matter the most when we're now asked to be so subjective, so personalized, so customized, and respond to just so much more?
I'll take the first stab at it.
Go.
So, I mean, just to come back to Kagisho's earlier point, right?
Yeah.
And maybe building on Georgina, what she said, is that I definitely think that the role of the advisor going forward is augmenting technology to do what's best for clients, right? You can see this in examples like with Vanguard, for example. They offer personal advice services. That's what their advisors are now doing. It's managing human behavior, letting the technology doing the hard graft of, picking funds and building portfolios, and then having the financial planner or their financial advisor there to really manage the things that are going to trip us up from realizing the returns that we want.
Okay.
And I think this goes back ultimately to what is the client's intention? What is their aim? Okay. So you mentioned it previously, which is that millennials, not all millennials want to change the world, right? Yeah. I can speak as a millennial saying that when you want to invest, even if you want to invest in ESG, you're going there with the goal of growing your money.
Yes.
Fundamentally.
Yes.
You're just wanting to do it a specific way.
Yes.
So I think some of the measures that are going to evolve is how are we aligning to the client's goals and objectives? So growing their money will always be something that we will have to hit. The way in which we do it will become varied. And I think when you talk about subjective measures, is that I don't think they are subjective. I think that everything, especially when what we do from a behavioral science perspective, can be quantified.
Yes.
Everything can have a data point mapped to it. And I think that's really what big data is. I think big data sometimes gets misunderstood as like this trove of endless data points that are being used, when in the reality, most models are using very few data points to build, outcomes. So I think for me, as we evolve and we're using data to a greater extent and we're starting to evolve metrics, it's about saying, how do we build a set of metrics that are important to the client, and to what extent do we deliver those? And obviously, things like aligning to values and will always be important, but it will be only one part of a series of metrics that make up, an interaction that we have with our client, and that will be very different. This is again what I was referencing with the segment of one. So I think that, as Georgina said, we have some way to go with robo-advice. And I think that advisors have an unbelievable role to play in the adoption of it and the management of the human being on the end of it going forward. But as we evolve, I think that the metrics that we start to determine, I think there are data points that we haven't considered yet that will start to become extremely prominent, as well as, in some instances, creating new data points where there aren't existing ones, even at the moment. So for me, it's about saying, what is the client wanting to achieve? How are we enabling them to achieve it? And if we're doing that correctly, that should have the bottom line results that we're after.
Okay.
Lynette, my view is, I think the sustainable or responsible investing is going to catch up with us quicker than we think it is. And the question of our stakeholders and our businesses being run for profit, 100%. But I'm starting to see a trend where the shareholders who used to be at the top of the pyramid are actually starting to go down a little bit. And staff, your people that work in the business, if any of my clients over the last 3 years have asked me any questions, it's about the staff movement in the business, because they build relationships with them. Those people are a whole lot more important to the end client than the shareholders are. So the trend that's actually happening is that the clients are starting to look at how you treat your people. They're starting to look at what businesses you're doing business with. I'll give you one example. Yes, it was one client, and our business is quite a diverse one. We don't only do investments and risk, but we do like short-term and various other things. We have a client, one, who was happy to move from one insurer to the other, simply because of the position that insurer took on vaccination. So it had nothing to do with the premiums, it had nothing to do with the product. So it was the moral position that a particular company was taking on that particular view. So it's the reason I'm saying it's going to catch up with us. I think in the past, trends took quite a while. But with the advent of social media, messages move a lot quicker. And often it's a small group, but they make so much noise on social media that companies are forced to actually change. So I think from an advice perspective, those that ignore the social trends and responsibly investing will do so at their own peril.
Sure. So
may I add to that? So I think when we're looking at like social media as well, we obviously have to take into consideration what people are taking about, when they take a position about something and how that affects their decision making. But also the fact that social media is affecting their financial decision making in the first place. If we look at like TikTok financial advisors, right? People who may or may not be accredited giving out financial advice to people across the world. Right, then you have groups like Wall Street Bets on Reddit, and we saw the impact of what that did to GameStop. So we have to consider people's information sources, right? And what may be important to one customer may not be important to the other. But we also have to understand that as things are changing, right, and social media has become and taken a more prominent place in our society, we have to understand that as professionals in this environment, we're not the only source of information from which people are getting, their advice. And we're going to be benchmarked and measured against a host of people, a host of platforms, that may or may not be reliable. So ultimately, I think it's not only about doing right by the client, but also understanding the environment in which now they're making their decision. It's not as closed off as it used to be. People have access to more information than they've ever had at the tip of their fingers, and they have access to platforms that allows them to make financial decisions with some large consequences fairly easily. So I think it's about making sure that not only do we manage that behavior, but we understand what's important to clients on an individual basis so that we can tailor the approach, because it's become, as you said earlier, it's become far more complex than it ever was.
Interesting. Getting financial advice and deciding where to, hold stocks via TikTok, which also means that faceless, nameless persons, organizations, it could be a 15-year-old who should be perhaps in a biology class at this point in time, giving that advice, and with the consequences you speak of. Georgina, I'm going to pose our final question to you as part of the panel before we close on some thoughts. Adam's response is unpacking to us that it's not just the traditional platforms that are now the ones that are both sources of information, but are also the ones that are collecting the information for analysis, tracking of data and client needs, but it's a whole new world out there. Now, as an investment professional, as a participant in the sector, as a business leader in the space, I know that you follow some of the technology trends in particular. What are some of the platforms that you've seen that are being used either locally or globally that are perhaps beginning to shape some of this alignment and streamlining of decision-making, focus and concentration, as well as implementation of these new practices, shall we call them?
Gosh, a platform's such a broad word as well. It has such a wide context, really. Yeah, I mean, look, it really interesting, and it again comes back to what is the advisor or the business you're talking about standing for. I mean, you mentioned earlier about building trust and changing clients changing based on vaccination positions. I mean, you remember when Macro gave a 10% discount when they said if you show your vaccination certificate, you get a 10% discount, and you've got a real first mover advantage in all of these things. So it's not just about the platform, it's about the innovation that goes behind the ideas that sit on those platforms. But when you think about platforms, there's so many different ideas about how to bring data to life and the consequence of client decisions to life to make sure that they're doing the right things. And I think our job in the financial platform world is to try to integrate into as many different platforms that the advisor uses to try to make his life as easy as possible. Try to reduce the costs in his business and enable his client value proposition. So when I think about some of the really interesting trends out there, I mean, there's a Scandinavian company going back to the ESG conversation, and that Scandinavian company, they've actually developed something for their clients. It's a credit card company, and they've said, look, as a young investor, you've said you want to only have a carbon footprint this big. We will let you have this credit card, and we'll assess where you spend your money. And when you reach the carbon footprint that you've agreed, we'll cut you off. So they cut off their spending. When they've reached that place. I mean, that's pretty drastic. There's all sorts of really interesting trends, I think, that we all need to be keeping track of. And there's some really interesting companies out there doing some great stuff on platforms that is more than just financial services. It's about life coaching.
Sure. Well, that brings us to the end of this conversation. But I can tell you right now, just off the back of some of the answers that you have given this afternoon, is that perhaps for our audience at home this afternoon, there is now a lot of research, a lot of thoughts, as well as ideas in the space of innovation, as well as integration, that now actually need to roll into practice. But I think so one of the most interesting takeaways for me is just a new version of thought leadership around risk, reputation, as well as client risk, because that's really, and management's really around that's come out of this conversation. It's not so much the things we can measure and follow, to Adam's point, the new measures we can create, the work streams we can put them in, or even the platforms we can play on, but it's also going to be very much the things that can't be seen, accounted for, touched or felt, that we're also going to have to take out of intuition and find ways to integrate them into our systems. So a very big thank you to our panelists this afternoon for sharing your insights, your experiences, as well as just some of the trends and practices that you are following. And I certainly hope that it has helped those who are joining us on the Think Forum this afternoon to expand their imagination about what's next for asset management in this particular realm. Ladies and gentlemen, at this point in time, I'm going to refer all of you to our screens as we unpack the results of our second poll this afternoon. And our results are up. We were talking on this poll about thematic investments. What you will also now see coming up on the screen is time for another quick poll, because I'm loving just getting some of your thoughts on the questions that we're asking and, of course, the conversations that we are having live in studio, but also online. And our third poll is coming up at this point in time on our screens, and the question has been asked related to COVID and, of course, how it is going to interact with each of us. Now, we're going to now carry on with our discussion. And at this point in time, I'd like to welcome back to our stage and studio Vimea Ferreira, who is 1nvest Executive Director. He's going to be specifically taking a look at the evolution of both our local and our offshore index investments and unpacking 1nvest's own outlook on the industry over the next 5 years. Vimea Ferreira, we're ready for you. Over to you.
Great, thanks, Lynette. It's quite a tough session to follow because I guess the interaction was quite good between the participants. And if I can just quickly share my key takeaway from that session, it's just that every human is different in terms of what they need, what drives their behavior, how they like to interact. So I guess the notion of one size fits all is becoming more and more irrelevant, and customization is becoming more and more relevant. So I guess it's a takeaway for all of us, from the product provider like ourselves, to the platforms, to the asset aggregator, to the advisor. It's our duty to think about that customization and how can we make it relevant to the client. So back to the session I'm gonna talk to you about today is what is in store for the index industry globally and locally in the future, but also take stock on where we came from and where we are at the moment. So if I think globally, it's a 50-year journey. You go back to the 1970s within the US, the first index fund was launched. And I like to think about the journey in the global space as generational, thinking about it as the grandparents, then the parents, and then the kids. So we're going to talk about 3 distinct stages. The first stage was 1970s. Some funds were launched. The first one was probably Vanguard and Jack Bogle launching a fund tracking the US equity market. Then you had a 20-year period of what we call unit trusts, they call mutual funds. A lot of index tracking mutual funds came about until the 90s. And the 90s are probably the second phase where ETFs were launched, firstly in Canada and then in the US. And over the last 30 years, ETFs have basically become synonymous with index tracking products and taken up that lead as being the major product provider into the industry. Then I guess the last section is probably starting at the global financial crisis around 2008, 2009, where we've seen a real acceleration in the adoption of index tracking products in globally, especially in the US. And I think that came about for various reasons. We've articulated that before in some material. I guess regulation, underperformance by traditional active managers, a low yielding environment, all of those things aided this industry that we call index tracking or passive or ETFs. So that's been the global landscape. In South Africa, our journey hasn't been that long, but it still goes back to the 1990s. Mid-1990s, 1995, 1nvest actually launched its first index fund called the 1nvest Index Fund. It was then under a different umbrella, but since then joined the 1nvest family. In 2000, the first ETF was listed on the JSE, and in the last 20 years, we've seen a lot of ETPs, exchange-traded products, being listed on the JSE. That includes ETFs, ETNs, and in the ETF market, we're sitting now in excess of 80 exchange-traded funds. Those funds cover various markets, geographies, strategies, and we see a similar space within the unit trust market. So as an industry in the last 25 years, we've come quite a long way. So how do we stack up if we look at the history and if we take stock of where we are now versus the globe? And I think let's discuss two key measures. The first measure is to say product, and the second measure is to say market share of index tracking products within the biggest savings pool. So if I think about product, we only have, and I use only very lightly, only have 85 ETFs where if you go to London or the US, you've got in excess of 1,000 on each exchange, which looks small, but remember our market is smaller. If I think about those 85 ETFs, they cover majority of asset classes, majority of markets, and the same is true within the unit trust space in South Africa. So as a financial advisor, as a retail advisor, as a asset aggregator, you can use passive only, and I don't necessarily like the word passive, I like more referring it to index tracking products. You can use index tracking products to construct a very well diversified multi-asset solution for your client. So I think from a product perspective, we're there. From a market penetration or market share perspective, if we look at disclosable assets, so let's look at the CIS market, then we're sitting at below 10%. So index tracking products make up less than 10% of the savings pool in South Africa, which is low if you compare that to the US, which is sitting at probably market-leading numbers in excess of 30%. If you go into Europe, they're sitting around 30%. So in that regard, we're lagging the market. But I do think there's a reason for it. And the reason is not that easy to discern, but I think we can draw from a couple of things to look at it. I think initially there were a couple of naysayers to say passive or index tracking doesn't necessarily work in inefficient markets like South Africa, but they work in efficient markets like the US. That's why the US market has grown that much. But over the last couple of years, various surveys have proved that the case from a performance point of view in the US holds true in South Africa. So I don't think that is necessarily true. I think another thing is the financial literacy of the individual or end clients in South Africa has made our market grow not as fast as in the US and in Europe. And I think there the financial advisor plays an important role, and we get it in a bit. But from the previous panel discussion, it was quite evident that choice and keeping grounded when information is abound and when market is volatile and when choice is great, that is where it's difficult to manage your end client. So I think all of the reasons why our market from a penetration or a market share perspective is behind global markets will fade in the next couple of years as we see financial literacy increase, regulation coming online, and a maturity in the advice process come about. So if I like to share a couple of key observations from the last 5 years, I think our market has moved on from thinking about it as passive versus active, or how should I pick an index fund versus an active fund, to focusing on the actual solution. So the building block has become a secondary decision. The client solution has become the primary decision, which I think is the important thing to focus on. And again, here the asset aggregator and the financial advisor has got an important role to play, because as we again just heard, keeping the client calm in those times is the thing to focus on, and to stick to one's values is the thing to focus on. I guess the second theme that has emerged for me, or the key observation, is there's been a realization that index tracking products is actually the best way to unbundle returns. And what I mean with unbundle returns, if I just think about the South African fixed income market as an example, in the past, you would have given money to a fixed income fund in South Africa, and that manager would have had the choice to pick between South African sovereign bonds, unlisted credit, listed corporate credit, SOE credit, and other banking type products that they can put into a fixed income product. Whereas now, if you want to unbundle your returns as a DFM or a multi-manager or even a financial advisor, you can now give a very specific ORBI or government bond index tracking mandate to an index provider, and you can give a very specific credit mandate to an active manager. So passive or index tracking products allow you to decouple or uncouple, like a big theme called fixed income, into various portions. And I think that is going to increase over the next couple of years. So let's look at what does the future hold. And I think when I wrote this down, I don't like scripted, so I like talking more. So it's almost CCTV if I think about it. And the 2 C's is choice, convergence, then the T is transparency, and next is value. So let's look at choice first. We all heard that information is plentiful, it's going to increase, people are bombarded. And I spoke to MSCI a while ago, and MSCI, you would know, is one of the biggest global index providers. Today, they are calculating about 250,000 indices on a daily basis. In 2 years' time, they see calculating about 2 million indices on a daily basis. In 10 years' time, they see themselves calculating 25 million indices on a daily basis. So we're going to go from 250 indices to 25 million indices. So that's 100-fold. So the choice is going to become plentiful. And as we know, as you get more indices, product providers are going to create more products. So the choice for clients are going to become a lot more. The problem with choice is if it's not disseminated correctly and if the information is not processed correctly, then people can make the wrong decisions. And again, there the financial advisor is very important to say, what is the right decision for my client and how does it fit into his solution and how do I ensure that that client stick to the solution to get his long-term goal? So the first C is choice. The second thing is convergence if I look at the future. Again, as I said in the past, it was very much index versus active and they were on different sides. But I think the world of index is converging in the middle somewhere and they're not going to meet, but you're going to get products that are very hybrid. And we spoke about thematic earlier, and I think thematic is the start of a convergence of the old passive and old active into something new. And what's an example of that? That is where a product provider or index provider has got a very specific IP or philosophy that they want to share with clients. Something like ESG is an example of that. Multi-factor investing is an example of that. So you write a rule for your investment strategy, wrap it into an index, and then you create an index tracking product. So we're going to get index products that have got an active component. A step further, globally, we've seen the first actively managed ETFs being listed. So it means you can have an active fund listed as an ETF. And why do they do it? It probably links into my third point, the T, transparency. I think transparency is going to be a lot more important in the future. We heard earlier around transparency around what do you stand for as a brand, transparency as a product, what am I paying for, what is the strategy trying to achieve. And I think index tracking products allows a client a lot more insight into what is driving my return, what am I paying for, what is the company standing for that's offering me this product, how can I buy this product. So I think that transparency is going to become a lot bigger globally. So it's the C, and the T, and the V. I think what drives the ultimate outcome of all of those is increase in volume and value within index products. And that's not index products of old, MSCI World, Top 40. This is a new hybrid product that is going to become very relevant in all client portfolios. I think index tracking products is going to increase in market share globally. I think as they shift from being standalone products to being in solutions, that's going to even further that. And I think the choice and what is available out there is going to drive. So my view is we need to keep ourselves grounded, decide what is important for the client, embrace the choice out there, but interact with it very responsibly. In South Africa specifically, I think you're going to get more product rollout. As we said, we've got 85 ETFs, a similar amount of unit trusts. I think the choice is going to become more. I think, as we heard earlier from Flobella, the market is shifting more and more offshore for, let's call it, discretionary savings. And there we're going to get more choice for local investors. So with that, I'm going to ask Lynette to join me on stage.
Well, welcome back to my stage. Fumea, thank you so much just for sharing, 1nvest perspective on some of the topical issues, priorities, as well as focus points for yourselves, both the short and the medium term. And of course, helping your colleagues across the ecosystem to make the best decisions, but also for themselves decide what it is that they're going to pursue next. Now, just as part of some of the questions that we have specifically asked here today, I'd really like to ask you if you could give me one or two innovations that you've perhaps been bouncing around and thinking of, or thinking about somebody who is a peer who could be working on in the space that could add value to clients in the short term in particular? Because I think everybody now realizes we've only got 6 Mondays to go to the end of 2021. But what does this mean in terms of just implementation in our own businesses based on this large volume of information we've gotten today? What is it that I can press a button on now to add value?
I think, Lynette, a lot of people start at the end when they try and solve a problem. So if we think about allocating to a certain building block in South Africa, so say you go to the exchange and you want to go and pick a top 40 ETF.
Yeah.
A lot of people start at that point and say, should I pick this top 40, this top 40, this top, or even they say, let me go and look at what's the ranking of all the funds and let me go and pick the top performing fund. I would say, because we don't have a lot of time before year end, because it's a volatile time, it's a difficult, sit back and say, why are you doing what you're doing? So why do I want to buy something? Why do I want to change my current allocation? If you can answer that why, then you go into saying, as we said earlier, the why becomes the primary decision. The picking a fund at the end becomes a secondary. So if you can revert back to the why, and I guess that applies to business as a whole. If you can revert back to the why, be sure why you're doing something, then I guess the decision of how do I do it actually becomes a lot easier.
So, just as you reflect on the why, I think one of the things we've reflected and weighed in quite heavily right throughout the program today, and just in some of the thoughts that you were giving us just now, is that we operate not in isolation, but very much in a global community and economy. But I think you can agree that as South Africans in particular, and in operation in our own unique local markets, we're faced by very different complexities and challenges. And being a participant in this market as well, what would you perhaps say is the foremost challenge that you foresee having, a seismic impact on the industry as we move forward? And what do you believe that what will always be the difference, though, as well? Because not all crisis is also fatal. But what will be the big differentiators for our market as well, just based on some of our complexities and dynamics as we move forward?
Yeah, I think that's quite a difficult question, but if I just think about what we stand for as 1nvest, and I guess our industry as a whole, it's about inclusion. It's about allowing everybody access to something without having high barriers to it. And that barriers is education. We spoke earlier about jargon. As soon as you include jargon, people think you're smart, but they actually don't know what you're saying. So do you create a language that is translatable? So do you include everybody in the conversation? Secondly, is do you allow everybody to invest? So do you have high minimums? So you actually, by having a high minimum, you exclude people. So how do we create low minimums? How do we talk to them the right way, low minimums, and get them to start earlier? And I think in a society like ours, where you've got a large disparity between have and have not, and education, financial literacy, and means you want to say, I'm not going to segment myself for a certain market. I'm not going to target the high end only. I want to open it up. I want to simplify the language. I want to lower my minimums, and I want to say everybody's welcome. And if you're willing to save and willing to learn, we're here to help you. And I think that is one of the big things that 1nvest wants to drive. I think the second thing is being here today. I think technology's been great, and COVID has pushed it. But I think we all yearn for this human interaction and actually having a real conversation. And I think, as Kagiso said, a lot of people transfer into the digital space, but I think that initial connection that needs to either happen directly with me or my friend has to tell me that he met the guy and he vouches. So there's something about this personal connection that I think is going to come back after COVID.
This relatability that we need to keep as a mainstay in making future decisions, in spite of just the advances and the progress. We still want to go back to number one, our own humanity and the humans around us. Well, to our audience that is watching this conversation, on our screen, screens now. We want to unpack the results of poll number 3 and, of course, flights, poll number 4, and our final poll as part of this afternoon's session and Think Forum. Thank you again to all of you for participating in the polls. I think you will have seen that as our conversation expanded and moved throughout the afternoon, it was certainly becoming more and more responsive to some of the thoughts that you were leading while watching us at your desk or in your home this afternoon. You know, Vimea, as we are now bringing our conversation here this afternoon to a close, for you, the first Think Forum, a very bold, innovative, and responsive platform created here today, and I think one that has opened its own themes for years to come. What have been your key takeaways?
I think, Lynette, listening to the panelists, it's clear that the rate of change is increasing. We heard about information, product, indices. So that rate of change is going to keep changing. I think in that, there are two things. I think firstly, you need to be comfortable with that and adapt to it. But secondly, you need to be quite comfortable with what you stand for. Otherwise, you're going to fall quite easily. So I think that rate of change is real. And the two takeaways is we need to adapt, but you need to be very steadfast on what you stand for and why you do what you do.
Well, I certainly love those. You know what they say? They say stand for something or fall for absolutely everything. Well, ladies and gentlemen, much to our opening a little bit earlier today, we did indicate that 1nvest Fund Managers are a licensed financial services provider, but the information that has been shared today as part of the Think Forum is purely for information and sharing purposes. Thank you very much to those of you who have participated in our fourth poll, and I can see that those results are quickly notching up on the screens around me already. So thank you very much for participating in that as well. At this point in time, I'd also like to let all of you know that the information that has been shared as part of our conversation this afternoon, the presentations, and of course a recording of this session will be made available to all the participants of this conversation and the Think Forum. Please just look out for your emails and you will be guided in terms of how to log in to that archive so that you may, of course, go back and reflect on some of the issues and themes that we unpacked and shared with you as part of today's session. With that, ladies and gentlemen, I think my key takeaways, Vimea, as part of the very first 1nvest Think Forum, was just that the role of integrity, innovation, and to your last point, inclusivity are really going to be perhaps some of the key game changers in ensuring that our ecosystem and our asset management markets remain not only sustainable, but also responsive to the needs of a changing society, a evolving and very colorful economy, but also an ecosystem that is hugely reliant on all of us at this point in time, not only thinking in the traditional, but thinking out of the box and out aloud in color. With that, a very big thank you to the 1nvest Fund Manager team, to our technical team that has supported us this afternoon, to our speakers who joined us from various locations on screen. Thank you to them as well. To my fellow moderator this afternoon as well, who led the conversation earlier on. And of course, all of our guests who made this Think Forum a fabulous success and such an enjoyable learning experience for not just myself, but I certainly hope for everybody who was able to participate today. My name is Lynette Nduli, and it's been an absolute pleasure being part of the 1nvest Think Forum. We hope to see you next year. Thank you very much.